I'm going to tell you something right now that's going to make you uncomfortable, and it should make you uncomfortable because comfort is the enemy of clear thinking. The Federal Reserve just froze interest rates, and the markets are doing exactly what you'd expect when central bankers lose their nerve. Stocks are surging. Gold is surging. Housing prices that were supposed to come down are surging, and the dollar is plummeting like a stone thrown off a cliff. Every financial news channel is celebrating this as if it's good news. Every talking head is explaining why this is bullish for your portfolio. Every analyst is raising their price targets and telling you to buy more. And I'm sitting here watching this circus thinking the same thing I've thought 100 times before in my life,
that when everyone agrees something is wonderful, that's usually the exact moment you should be asking yourself, what could possibly go wrong? Let me be absolutely clear about what just happened, because the financial media is going to spin this in ways that serve their advertisers and their narrative, but not necessarily your understanding. The Fed froze rates not because inflation is conquered, or because the economy is strong, or because they've achieved some mythical soft landing that every central banker in history has promised and none have delivered. They froze rates because they're terrified. They're terrified of what happens if they keep raising rates and something breaks in the financial system. They're terrified of a recession in an election year, or any year really, because recessions are politically unpopular, and central bankers, despite all their pretensions of independence, care deeply about political pressure. They're terrified that they've painted themselves into a corner where every option available to them is bad, and they're just trying to choose the least bad option and hope that something miraculous happens to save them from the consequences of a decade of terrible decisions.
Now, I want you to think about what it means when stocks and gold and housing are all going up at the same time while the dollar is going down. This isn't normal. This isn't how markets are supposed to work in a healthy economy. In a healthy economy, you get trade-offs. You get assets moving in different directions based on their fundamental characteristics and risk profiles. When everything goes up together except the currency itself, that's not a sign of economic strength. That's a sign that people have lost faith in the currency and they're running toward anything that isn't a promise from the government. They're running toward stocks because at least companies own real assets. They're running toward gold because it's been money for 5,000 years and probably will be for 5,000 more. They're running toward housing because land is finite and houses are tangible. What they're running from is dollars and the promises denominated in dollars because they're starting to realize what some of us have known all along, which is that the Federal Reserve has no good options left. Path forward involves some form of currency depreciation. Let me walk you through the logic here because it's important you understand the trap the Fed has created for itself and for all of us. If they raise rates aggressively to fight inflation, they risk breaking something in the financial system. We've already seen cracks. We saw regional banks failing. We saw commercial real estate struggling. We saw highly leveraged companies getting squeezed. The entire modern financial system is built on the assumption of perpetually low interest rates and cheap money. And when you take that away, things start breaking in ways that are unpredictable and potentially catastrophic. So raising rates much further is dangerous, and the Fed knows it. But if they cut rates or even just freeze them where they are now while inflation is still above their targets, they're essentially admitting defeat. They're admitting they can't control inflation without breaking the economy. They're admitting that the promises they made about getting inflation back to 2% were fantasies. They're admitting that we're stuck in a world where you either get persistent inflation or you get economic collapse, and those are your choices. So what did they do? They blinked. They froze rates and hoped that somehow inflation would come down on its own without them having to do the hard work of maintaining tight monetary policy long enough to actually kill it. And the markets immediately understood what this means. It means the Fed is more worried about breaking things than they are about inflation. It means when push comes to shove, they will choose to let your currency depreciate rather than risk a financial crisis or deep recession. It means the printing press is still the ultimate answer to every problem, even if they're not actively running it right this second. And so people are rationally moving their wealth out of dollars and into things that can't be printed. Now here's where it gets interesting and where most people are going to make catastrophic mistakes with their money. When you see everything surging like this, the natural human instinct is to feel like you're missing out. You see your neighbor making money on stocks. You see gold bugs crowing about being right. You see real estate investors talking about their rising property values. And you think to yourself that you need to get in on this action before it's too late. You think you need to buy stocks at all-time highs because they're going higher. You think you need to buy gold even though it's already run up substantially. You think you need to buy a house even though prices are at levels that make no economic sense relative to incomes. This is the moment when more wealth gets destroyed than almost any other moment in market cycles. This is the moment when ordinary people who have been prudent and saved their money get suckered into buying assets at exactly the wrong time because they can't stand watching everyone else get rich. Let me tell you what's really happening, because I've seen this movie before and I know how it ends. What you're witnessing is not sustainable economic growth or a healthy bull market or a new paradigm. What you're witnessing is the late stage of a monetary inflation where people are starting to lose faith in the currency and scrambling to convert their paper wealth into anything real before the paper becomes worthless. This is what happened in Weimar, Germany before the complete collapse. This is what happened in Argentina and Venezuela and Zimbabwe and every other place where central banks lost control. The stocks went up. The real estate went up. Everything went up in nominal terms while the currency collapsed, and the people who thought they were getting rich by riding the wave up discovered too late that their gains were an illusion. They had more units of currency, but those units bought less and less. They could sell their stocks for millions and feel wealthy, but those millions couldn't buy what thousands used to buy. The number in their bank account got bigger, but their actual purchasing power, their actual standard of living got worse. The difficult truth that nobody wants to hear is that when everything goes up together, it means nothing is actually going up in real terms. It means your measuring stick is breaking. It means the dollar is losing its function as a store of value and unit of account. And when that happens, you need to think very carefully about what you own and why you own it, because the rules of the game are changing in ways that most people don't understand and won't understand until it's too late. To protect themselves, you can't just look at nominal prices anymore. You have to think about what those prices mean in terms of real purchasing power. You have to think about what happens when the currency continues to depreciate. You have to think several moves ahead like a chess player, not just react to what's happening right now. So what should you do? Here's where I'm going to give you advice that's going to seem boring and insufficient given the drama of the moment. Don't chase performance. Don't buy things just because they're going up. Don't assume that because stocks are at all-time highs, they're going higher. Don't assume that because your neighbor made money flipping houses that real estate is a sure thing. Don't panic, but also don't be complacent. What you should do is take a hard, honest look at what you own and ask yourself whether it will retain value if the dollar continues to depreciate. Do you own businesses with pricing power that can pass costs on to customers? Do you own real assets that have intrinsic value independent of the currency? Do you own skills and knowledge that will be valuable regardless of what happens to paper money? Or are you sitting in cash watching it lose value every day? Or are you in bonds that are guaranteed to lose purchasing power over time? Or are you in speculative assets that only have value because of momentum and greater fool theory? The Fed freezing rates is not a green light to speculate wildly. It's not permission to abandon all discipline and chase whatever's hot. It's a warning sign that the people in charge don't have this under control. It's a signal that we're in a regime where currency depreciation is the path of least resistance politically and economically. It's a reminder that you need to own things that maintain value when paper doesn't. But it's not a signal to abandon all caution and buy everything that's going up today. Some of these assets surging right now are genuinely valuable and will preserve wealth through whatever's coming. Some are bubbles being inflated by cheap money and fear and will pop spectacularly when sentiment shifts. Your job as an investor is to know the difference, and that requires thinking clearly, not reacting emotionally. Gold going up makes perfect sense in this environment because gold is what people buy when they lose faith in central banks and fiat currencies. It's not going up because gold suddenly became more useful or more beautiful or more rare. It's going up because dollars became less trustworthy. People are looking at the Fed's decision and thinking if they won't fight inflation seriously, then my dollars are going to lose value and I need to own something that can't be printed. That's rational. That's smart. Gold has been money for 5,000 years, precisely because governments can't print it and politicians can't debase it. But that doesn't mean you should rush out and buy gold at any price. It means you should understand why it's going up and whether it makes sense for your specific situation. Housing going up is more complicated and more dangerous. Some real estate in good locations with strong fundamentals and limited supply will hold value through inflationary periods. If you own a house in a desirable area with good schools and job growth, and you can afford the payments, then you're probably fine. But some real estate is being bid up purely by speculation and cheap money and the assumption that prices only go up. Some real estate makes no economic sense at these prices. Some markets are going to crash hard when the inevitable correction comes. The fact that housing prices are surging doesn't mean you should buy a house. It means you should be very careful about which house you buy and how much you pay, and whether you're buying it for the right reasons. Stocks going up is the most complicated of all because the stock market is not one thing. It's thousands of individual companies with different business models and competitive positions and exposure to inflation. Some companies will thrive in an inflationary environment. Companies that own hard assets, companies with pricing power, companies that produce things people actually need. Some companies will get absolutely crushed. Companies with high debt loads. Companies in competitive industries with no pricing power. Companies whose entire valuation depends on growth assumptions that only make sense with cheap money. The market going up as an aggregate tells you nothing about which individual stocks you should own. It just tells you that people are moving money out of cash and into equities because they're scared of holding dollars. What I know from nearly a century of watching markets and studying history is this: when central banks lose control, the early stages feel like prosperity. People feel rich. Asset prices rise. Everyone's making money on paper. It seems like the good times will never end. Parties get bigger. People quit their jobs to trade stocks or flip houses. Financial gurus emerge, promising to teach you their secrets. It all feels wonderful and exciting and like you're finally getting ahead, but they always end because you can't print prosperity. You can only print money, and printing money without producing real value just redistributes wealth from savers to debtors, from the prudent to the reckless, from the future to the present. Eventually, reality reasserts itself. Eventually, the bill comes due. Eventually, you run out of other people's money to redistribute, and the whole scheme collapses. The Fed freezing rates while inflation remains elevated is them admitting they're out of good options. They're choosing the slow poison of inflation over the quick death of recession. They're gambling that they can manage this without it spiraling out of control. Maybe they can. Maybe they'll get lucky and inflation will come down on its own without them having to finish the job of raising rates enough to cause real pain. Maybe productivity gains from technology or demographic shifts or some other factor will save them from the consequences of their decisions. Maybe some miracle happens that lets them thread the needle between crushing inflation and crushing the economy. But betting your entire financial future on central bankers getting lucky is not a strategy I'd recommend to anyone who wants to sleep at night. What you're seeing right now with everything surging is not a time to celebrate. It's not a time to feel smart because your portfolio is up. It's a time to make sure you're positioned for a world where the old assumptions about money and value may not hold. It's a time to be skeptical of narratives and crowds and certainty, because the only thing I'm certain of after watching this game for 99 years is that when everyone's certain about what's going to happen next, they're usually wrong. When everyone agrees the Fed made the right move and everything's going up and you should buy more, that's exactly when you should be most careful, most skeptical, most willing to go against the crowd. The time to be greedy is when others are fearful. Right now, everyone's greedy. Everyone's piling in. Everyone thinks they've figured it out. You figure out what that means for you and your money.